Greetings, Dr. Jeffrey Scott. This is the second part of my weekend market update for August 31st, 2025. As I titled the one I did on Friday, as a strong August ends, what will September bring? And this is part two, stocks I will be watching. I'll do a quick review of the markets, and then I'll show you 5 to 7 stocks I like, and then maybe we'll work up from an options perspective how I'm going to play one of them. Again, my name is Jeffrey Scott. My email is marketmripro@gmail.com, and my Google group is called Top Down Trader. This is for educational purposes only. Any recommendations in the spirit of education and should not be considered investment advice. The intent of the video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk, and you and you alone are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky. You should consult with your financial advisor before making trades. I have tools for multiple platforms, but I am an independent trader. Okay. Look for my wealth charts video? Not yet. Look for it before the market opens on Tuesday. I'll do it sometime on Monday. You know, typically at night I've got futures that are meaningful. And interesting thing is the futures are up a bit. The Dow's up 100, Nasdaq's up 70, S&P 14, and the Russell's up 5.5. A little bit of a rebound, perhaps, from what we saw on Friday. Perhaps it was the news that the court struck down the Trump tariffs, which I can't even figure out what that means, except they're giving him until October to um, overturn their opinion, appeal the opinion, and then obviously it ends up in the big courts, and we'll decide what happens. Interesting times. My Google group is called Top Down Trader. It's the way that I reach out to people that want to follow me. I let you know when I post things. I give you discounts on my tools. I have education that I don't post anywhere else. Like, for example, we'll be doing an education program tomorrow. That's a good chance it won't make itself onto YouTube. If you're interested in joining, and there's absolutely no cost. And since you get free discounts, it's like getting something for nothing. So go to Google Groups, look for all groups, find Top Down Trader, let me know how you want to be contacted. Even better yet, come visit me in Palm Beach Gardens. We are just north of Palm Beach. What a beautiful day until about the typical 4 o'clock when the thunderstorm started, but we're out on the boat all day with a bunch of our friends. On October 26th and 27th, I will be doing a live meeting at the Marriott Palm Beach Gardens, 15 minutes north of PBI. 2 packed days of education. It's 1250. I feed you, water you, entertain you, take you on a dinner cruise. And then if there's enough interest, we'll go out to dinner on Monday and you can take me out to dinner. The hotel is a full service Marriott, but you won't need that because you'll get all the food you need from me. But it's 155 a night. John Person, a great friend, trader, educator, software developer, he has his meeting the 2 days before, the 24th and 25th. Separate fee, separate location, about a mile away. Save on airfare. Come one airfare, buy two, gets 2 meetings. Go home on a Monday night. And for your 1250, I'll give you a $400 rebate off of the purchase of any of my tools. And there should be an asterisk there. Tools that I control cost on. If you already have all my tools, and the only ones I control cost on are the app that we use here, the TradeStation, the TradingView tools, then I'll give you that rebate towards next year's meeting if you want to come back, if you don't have any tools. Metastock, I may have some influence on them. What I'm going to be doing tomorrow at 11 o'clock, and I'll have the links in the remarks section below. I've got some new features to announce that Praveen and I have. I've come up with some. Praveen's come up with others. Praveen does the magic. So I'll show you the new features. We'll have an Ask Me Anything workflow review, and there'll be a registration link in the remarks section, as I said below. Know your news and earnings. Not much news on Monday because it's Labor Day, but lots of Fed speakers. You got a beige book. You got ADP employment, U.S. Monthly employment reports. Probably going to be the most important thing of the week, I suspect. Um, Earnings were not done yet. Salesforce, Credo, data center play on the cooling. side. C3AI never really has done a whole lot. Hewlett Packard, DocuSign, Lululemon, or Lululemon, or however you call it. So there's still plenty, and we're about to lap this earnings period and start thinking about the fourth quarter. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. If you wonder why there's so many bearish people out there, S&P 500, the Qs, the Russell, and the diamonds. And if you look at across the top, it shows you the average return by month. And you could see for the S&P, for example, there's only 3 negative months out of the year. For the Qs, it's 2. For the Russell, on average, it's 2. And on the diamonds, only 30 stocks, there's 5. The one with the worst performance across all of them is September. Now it's only negative a little bit more than half the time, but I think if you hear a lot of negativity in the press right now, it's because we're going into a month that's tough. And not only is it negative only half the time, there has not been major declines, 10.9, 9.9. Those are pretty significant. Um, Sometimes in October we'll get even bigger ones. On the NASDAQ, you could see a 10.7, 15.6, 20.9, 12.9, 11.8, a lot worse. So I think it's important to know history and to know that it's a tough month. Doesn't mean we're going to go down. A lot of people thought August would be negative as well. As you could see, August, at least for the diamonds, the spiders, it's a negative month as well. So happy September, and let's see how it goes. For more information about anything I talk about or I do, or my live meetings, or any questions for me on anything that's reasonable, marketmripro@gmail.com. Tech questions about the program, Praveen's at coding@marketmripro.com. And consider joining my Google group. If you have any of my tools, if you like top-down investing, if you're starting out and you're looking to have another opinion of what works and what doesn't work, welcome aboard. And like I said, you'll never pay me anything unless you want some software or come to a live meeting. And on to the charts. Um, and I've said it before, um, a lot of times when I go to meetings, whether I'm speaking or attending, I just go by myself. I don't want to be bothered by bringing my wife, although I love my wife of 40 years very much. We spent a great day on the boat with a bunch of other couples. The reality is, a lot of times you take them to some destination where there's nothing to do, and all they do is shop and get bored, but not here. This is the Marriott Singer Island, 10 minutes from where our meeting is, one turn away. I used to live 2 doors down, um, and it's a heck of a great place to hang out. So bring your spouse, bring your family for a little bit of an early um, fall opportunity to spend some time on the beach. All right, so um, just to do a very quick recap of what I thought about the markets. When we looked at okay, let me set that up. When we looked at the markets, kind of the gestalt on the market is we are close to all-time highs on the major indices. We're a day away from it on the spiders. Okay, we can easily come in here and let's blow it up. Look at the spiders and say, boom, there's your all-time high. And we're right under it. Um, be bullish. The market's going to blast through and go higher. It probably will, but when? If you look in the past, you see 4 or 5 day pullbacks are very common. We've had a 1 day pullback. My expectation is we get something like this or like this. We've got, sorry about that. I have to forget not to hold on to the mouse when I do this. A pullback to the 50 wouldn't surprise me. As we've talked about, you're looking at the difference between, look up the upper left-hand corner, we closed at 645, the 50, 629. At 16 points away, it's less than 3%. Um, I'm not looking for a major sell-off, but this is seasonality. Looking forward, 10 years average. We're going into a little tougher time. October is recovery, and then you get to November and December, and we do well into the rest of the year. Past performance is not indicative of the future always, so you got to be careful. But past performance would suggest we got a little bit of challenges coming. So here is a little different. Here we have the Qs, and the Qs, here's your all-time highs. And I could probably put a trend line here because right now I got to break above that. And, the 50 is sort of a no-brainer, but will that be enough? And as you could see, similar to the S&P, sideways to down is the expectations based upon seasonality. So the Qs, their new highs were maybe, is it 10 days away? Let's go back and look. I should have counted. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days ago, the Qs hit their all-time highs. Hard to be horribly bearish at the tops, but they're tops for a reason. Sometimes it takes a while to go on to the next top. Diamonds, they are only a few days off of their all-time highs. You can see their all-time highs are right here. Let's go that. And so they pulled back, ran up into this, and would it be surprising to see this, to see this, to see this, and to pull back into the 50? It would probably be healthy long term. So again, we could break right on through to the other side, open up a door, no pun intended, to newer highs. I think we go back and we retest. I think it's a good chance, especially considering the seasonality. No one says that you have to follow what Jeffrey thinks, by the way. Let me go back into that. And let's hit this and let's go to here. And, the Russell, unfortunately, well off their highs, but like the others, has had a major move. And it usually will have the same type of pullbacks. Hard to say that we've started that, but, you know, are we going to pull back into this area? Seasonality not as bad as some of the others, but still negative right here. VIX really didn't start to move too much. You could see a little move on Friday, up 6.45, and the dollar is bouncing around under resistance. What was remarkable to me is what I'm going to show you here. And a couple of the stocks that I liked have to do with this chart. Because I think you could probably say that gold is in the process of breaking out of a base that's gone on since April. That's a pretty good base. 5 months, 4 months, and a breakout there. You think about it, if we have inflation, gold goes higher. If we cut rates, gold goes higher. But the only time it won't go higher is if we don't cut rates and we have and the market slows down. Maybe that'll hurt gold, but it might be a good hedge in here. So gold looks to break out, and also super strong here, nowhere close to all-time highs, is silver. And I think you could certainly argue that silver looks good here as well. Oil, not so much. Natural gas, forget it. And the 10 years are bouncing around, still below 5% on the 30-year. And we'll see where we go there. So that's my thought on the markets. Again, and to summarize it, hey, we could go to new highs here. Certainly could. But now let me show you the reasons why I think we pull back. I'm going to pull up TradeStation, and not for the usual reason of showing you my app there. I have a lot of tools. I have so many tools, it's annoying. Um, but I love looking at pools. So I have set up in TradeStation my weekend combo buy, which was 620 stocks. And I'm looking for stochastic divergence, CCI, MACD, and RSI. So the first thing I see is the spider has bearish CCI divergence, bearish MACD divergence, and bearish RSI divergence. Um, that might be worrisome. Um, we could see here that the Qs have bearish MACD and the Russell has a bearish RSI. But what about the stocks underneath? I am not going to show you 600 stocks that I thought were lousy. I put this list together of attractive, fundamental, or technical stocks. So if we look at how many bullish stochastic divergence, none. Bearish, quite a few, including a firm which broke out nicely and then had an intraday reversal on Friday. You can see it opened here, traded higher, closed down here. All right. How about CCI divergences? One on GFL, an environmental company. And you know, you can see past divergences. It doesn't happen immediately, but it goes higher. Negative divergences, it doesn't happen immediately, but it goes lower. Negative divergences, I pay attention to divergences. How about bearish CCI? A lot. So I might look for expensive stocks, not cheap stocks, that have multiple divergences occurring. But these are the bearish CCI. How about bullish MACD? Remember, these are stocks that looked attractive. Equity, lifestyle properties, bullish. And you could see bullish here. This is going higher. Um, will it break out here? I'm not chasing that one. It didn't break out here. How about negative MACD? Quite a few. Positive RSI, and then bearish RSI. There is a lot of negative divergence in technically attractive or fundamentally attractive stocks. That probably tells me something. Why else am I a little bit bearish? I'm still having to justify in my mind what to do about these two Hindenburg omens, which were confirmed Hindenburg signal. So it was on this bar here, and the date of that bar was August 1st. Here was the follow-up Hindenburg omen, and I've done multiple videos on the Hindis, and they're often a sign of a top, and you can get a modest correction, which is kind of what we've had here, and then we've gone higher, but it could also predispose us to a much bigger one. So it's something I watch, and then we had this white line, or it's actually green on the border, um, called a Eureka, and when you get those at all-time highs, it usually means too much exuberance. So that's got me a little bit nervous. And then when I look at the breadth, especially the small caps, the new high, new lows are at a level 93%. I expect a reversal. And you could see the spiders still very high at 0.96, S&P 1500 0.95, although the NASDAQ has come off with its recent weakness. So again, a number of reasons that have me concerned. And then I can't forget that on my timing model, on the daily model, the NASDAQ is sitting there in a sell signal, although the weekly model is bullish for everything. So I'm not saying to sell the market. I'm not, I did get some contras. I'll mention that later and raise some cash. I just think it's September and there's a lot of things that tell me the market's under pressure. I'll leave it at that. So today's supposed to be about stocks. And let me start a program while we're doing this. I have a lot of programs, people who've been to my meetings. I often play a game with them and basically bet them that they can't find anything I don't have already or haven't tried. All right, I'm going to have to go this way. So this program is Dynamic Trend, I think is what it's called. And um, Tom Joseph, who did Advanced Get, it's his program. Um, VectorVest licensed it, and it's actually cheaper for me through VectorVest, and hence why I'm opening it within VectorVest. You don't have to have VectorVest to use it. You have to have somebody's data platform. So that's going to load up in the background. Those who've been here before know that I like to use that for looking at potential stocks. So let's talk about gold. So there are a lot of reasons to like gold. Um, it could be a hedge about from inflation. It could be a benefit of rates lowering. And as I mentioned before, it doesn't take too many squiggly eyes to say, hey, we just broke out above a multi-month base. So GLD is trading at 317.03. Now, question becomes, do you want to buy gold or do you want to buy a gold miner? So GDX is gold miners. Gold miners look a little different, don't they? They've already run quite a bit, but they should benefit just like gold does, GLD, if the price of gold goes higher. So when I looked at the two of them, I kind of think I like buying gold because it's not extended. If you look down here, relative strength is breaking above moving average. OBV is breaking up. You had some good volume of it the last couple of days. And as we talked about, it kind of looks like it's taken out resistance. So I like GLD. Now I can go into my top down area and go into their basic materials and I can find gold and maybe silver and I could see I've got 46 of them. Enough so that it wouldn't be a horrible thing to run through every one of them. So let's look through some and see if we find anything that looks good. AEM, beautiful uptrend, looks a lot like GDX breaking out again, probably getting extended, but the last high jump is at 90, so I could buy it. Decent volume breakup momentum, good relative strength at OBV. The next one is Wheaton Materials, Wheaton Precious Metals. This is a silver play. So you had a false breakout, came back down to the 50, taking out the chandelier stop here, not extended. You got momentum and volume, good relative strength in OBV. And what about extension? 79, I could certainly buy that. So WPM is one on my list. And I just go through the list here. RGLD, Royal Gold, not as much. Franklin, Nevada looks great, but it's moved too far. AU is another one I like that is pulled back. Um, Looks poised to go higher. Newmont, these look like technology stocks. Goldfields is one that I've been in and out of, a little pullback here and breaking out, lower cost, although it's not cheap anymore. The one that I picked was this one. And why did I pick this one? I picked SA because I thought it'd be worth working out up a cheaper stock, and it just took out that trend line. And it's 80, so it's not too extended. And it had good volume coming out of a squeeze, breakout momentum volume in a CPR, relative strength and OBV turning up. So the two stocks that I picked, two of the stocks I picked up to look at further are SA and WPM. And I would just go through the list, and I probably won't go through all of them tonight, but there's a lot of, this one's moved a lot. OR royalties breaking out nicely. Um, just a lot of beautiful patterns. But the two that I found that were probably Kinross I've liked. Um, this is one I'm in, EGO. I like buying them at breakouts. So you could see a lot of nice looking stocks. So I'm going to go with those two. So we're going to let's let's start to build a little list of what I'm interested in. And what we're going to call that list, let's see if we get this here. Oh, where do I want to put it? I guess I'll put it in here. And we're going to call it Web Buys, New Text, I'm going to move it to another. Why doesn't it say web buys? Because that's what it's supposed to say. Let me look at that again. There it is. Perfect. Just going to move it to the other monitor for now. And I'm going to put in the stocks I'm interested in looking at. I'm interested in SA and I'm looking in WPM. Let me just look at a couple of other things that I thought looked interesting. BABA. BABA came out. It looks kind of funny, doesn't it? But how about that? This is a breakout from a long-term trend line. Massive volume, gap, volume, breakout momentum, recently in a squeeze, relative strength and OBV looks good and not extended. I go up here and I could see it doesn't look that good. No surprise, minimal growth on earnings. Revenue grew a little bit. No surprise there. $1.57 versus 215. That doesn't look very good. So I would go over here to the news, and here it's now a cloud play. Why the stock has gone parabolic. So there's a lot of things that you could read here to get an impression about whether or not you think BABA has changed its colors and it's time to run. Personally, I love the pattern. I think it ran too far for me to get a good stop position, and that's my problem with it. If I was to buy it up here at $136, 8% on that, 8 and 8% of 36, $3, so it's about 11, which takes me down to 125-ish. So my stop would be down here, which is way too long, and there's no natural reason to have the stop there. So I'd have to just pick a place in the middle of the bar. To me, it's not my favorite way of playing. So I'm going to pass because I don't see a good stock, a safe stock, safe stop. I think Baba is going to be something great to own. I bet it pulls back like it's seasonality, and I'll be looking for a better entry point. I may not get one. Baidu, staying in China. Come on, Baidu, give it to me. So Baidu has been in a long-term downtrend and kind of a loosey-goosey looking chart. Um, but it just had a breakout, as we could see here, on massive volume. CPR, volume breakup momentum, relative strength, and OBV look good. And if we go in here, we could see earnings, not much earnings per share growth. We're going to have $1.67 versus 236, so negative. Maybe it's because of the Supreme Court, but that came in after hours. But Baidu, from a technical perspective, you just got to start wondering if it's done going down. Now, what's the big difference between this and Baidu? Well, one thing is I've got a trend line here that if they fail to break, I'd want to be out. I could also put a stop here. Let's look at this here. So I look at various things to put my stops, but I'm seeing here a line that has been support multiple times, and then you wonder, does this line turn into resistance? So that line's at 90.85. The stock price is at 97.20, and no, not even 96.15. What's the high? On this bar, look up to the upper left. The high is 96.28. So if I bought it for 96.30 and my stop was at 90.80, that's only 550. That's about 6%. So unlike the other guy, I have a rational place to put my stop. That's within 8%. So Baidu might be something. Let me go put that on my list. BIDU. Next one I wanted to look at, and these have all been pre-screened, CVI. So we must be getting to that time of year where we shift the refiners from summer to winter. And that's a time that has often been a place where these refiners will rally. Technically, I mean, fundamentally, they look like garbage. They don't make any money. They're projecting 20 cents in October versus losing 50 cents the prior. That's nice. 187.63 in October versus 183. That's kind of flat. Lots of red here. Because of this, they trade at a, well, usually lower. 38 multiple seems high. This one pays an 8% dividend. And what I liked about this one is, again, I like to always know where I'm going to put my stop. And, I'm going to put my stop right underneath that 50. So I'd be putting a stop at 27.34. I'd be buying it at, what was the high here? Open high, 30.50, not 30.60. Yeah, that might be too far of a stop. I want to be within 8%. And if I start to tighten it up, I'm starting to compromise. So that's how I sometimes weed through these stocks. Another one I liked was DTM. DTM is an MLP. This is the kind of thing that is pretty stable regardless of what the economy does. If you look at their earnings, they're really stable. Um, a consistent turtle. You look at the revenue, a little bit of growth, but pretty consistent. Um, Not a whole lot of surprises on revenue or earnings, but they do get them sometimes. And what I liked about this one was a couple of things, but I could draw a line through these, through there. So it's breaking out, which is the pattern that I like. It's got a dividend 2.89%, and it's going to make $1.05 versus 90 cents. So that's 15 cents if there's no surprise, or 15% growth, which is increasing earnings growth. I think this one looks good. If I was to buy it, I would buy the stock because I'm buying it for the dividend. So I don't, if I'm buying something and I like the dividend, I don't buy options because I want to get paid. All right, so that was DTM. I just added that to potential. NLY. I don't know anything about this company. I don't even know what they do except to some specialty mortgage. Um, it's you're not buying it for technical reasons. You'd be buying it for it pays a 15% dividend, and technically it's in an uptrend. Let's look at what it looks like on a weekly. How do you like that? Flat as a pancake over on a weekly chart. Now, it did come down from much higher numbers. We go to monthly, and you could see that. But if you buy it and it goes nowhere, you're collecting a pretty fat dividend. So again, it is not, in my mind, an earnings story. It is a story about the dividend. And why did it make my list? Because it's broken out, it's going sideways, had a little flag there. Looks like it's going higher. And then lastly, nope, that's it because the next one's WPM. So looking at all these, I'm going to have to decide, do I want to work up SA? So let's look at SA again. I just love this picture. The lowest in the last four is here. So let's see what that would have been in. So looking at about 1637, would be buying it at 17.65, $1.30. It's about 8%. I can tolerate that. Now, I might be thinking it looks kind of like it's going sideways in this area and pull it down here. And that's something I would consider. It was resistance here. It's been support. And that might be a safer place to put it, but it also means I'm risking more money. So SA is a $17 stock and it has a, oh, come on, sometimes if you type them in, they don't like you as much as if you get them out of the column. So there's SA. Well, it doesn't want to give me any of the fundamentals. All right, sorry about that. And the other one is WPM. I think silver is very interesting here. It's a $101 stock. Look at the earnings per share growth. Surprises. Only a 1% dividend. Big multiple. So WPM or GLD, which one looks more interesting? Or SA. Here's what I did on Friday. On Friday, I saw this, and knowing the time of year, and knowing I wanted to be a little bit defensive, I said, I like this GLD, and I think it's breaking out. So I actually bought some on Friday. I didn't buy the stock. Let's see if it pays a dividend. It's an ETF, so it probably doesn't pay a dividend, or it may, could. I don't think so. I don't have the fundamentals on it, so I thought I'll buy GLD. So let me clean this up and work you through my thought processes. I am directional on GLD. I would validate if it has a dividend, how much of a dividend it has before I did anything. But let's pretend it doesn't. So let's put in GLD. We are now in September, or we will be by the time the market opens. So September 19th to me is only 19 days. It's not long enough. So I'm going to look for options now that are the monthly October 17th. I am going to be bullish. So I'm going to go in here and I'm going to look for bullish options. Long stock, long call, short put, covered call, bull put, synthetic long, call ratio back spread, um, married put. I'll talk about how I turn a butterfly into a bullish position, and that's a good start. What I have here is, hold on, let me do some more. So starting strike, it's 318. So let's look at they actually are 316, 318. God, they got calls at every dollar. All right, we'll use at the money calls. I'm looking for, let's say, this is $300 stock, a minimum of $10. And what I like is I want directional options, which means, and I'm bullish, and I want things that have unlimited upside and a downside that I can control. And what this spread calculator has done for me, it's taken and it's looked at various spreads here that I identified. It's showing me the probability of, well, of where I have to go to break even, the likelihood of being in the money, and my maximum profits, I like infinity. My maximum risk, I like low. And how much does it cost in red, or how much am I paid to take the trade? And then what's my potential ROI max on the trade? So let's think about this. Let's say I buy 100 shares of stock, long stock at $318. I add two zeros, it's 31,800. So if I was to buy the stock, let's talk about some key things here. We don't need this. Here is today's price. The horizontal scale is what price does. The blue thing is what my P&L does. Okay? As price goes up, my profit goes up. As price goes down, my profit goes down. One call is equal to 100 shares. So we'll be looking at one option contract. If I buy the stock, I have unlimited gain. However, if I held it to zero, I'd have a loss equal to my payment. So if I bought it for 31,807, my profit opportunity is infinity, but my maximum risk is how much I paid for it. If I wanted to buy 10 contracts, it would cost me $318,000. So I like gold. I'd like to control a lot of that. I want to keep this if I can, but I want to break this so I don't have unlimited risk. So let's look at some of my favorite ways to doing that. So I would like you to stick in your mind this pattern and what I'm trying to do. If you're an options trader, this is boring for you. If you're new to options, I am going to demystify the options for you. Okay. How about just buying a call? So the nice thing about buying a call, here's where we are today, is that instead of spending $31,000 to control 100 shares, you're going to pay $818, give or take, or $817 to control that much. Now, the nice thing about owning that call is you have the same to infinity beyond as you do in owning the stock. You've met my goal by capping your losses. It's a relatively cheap way, so you're spending $8,000 to control 1,000 shares until the expiration day in October. If the 1,000 shares go up 10 bucks, then you'll make 2 or 3 bucks at expiration. If they drop, the most you can lose is $8 per contract. Again, depends what or $8 per share. It depends on how many contracts you buy as to how much that will be. So the good news here is maximum upside, controlled downside equal to the cost of the call, which is 817. Options are risky. The Options Industry Council has some great education for buying options, and they want you to for me to tell you that buying options are risky, or trading options are risky, and I fully agree. However, buying an option, the worst you can do is lose your premium. So, not a bad trade. Let's remember that $817 out of your pocket, maximum risk. Here's the other problem. The stock is $318 here. You're buying a $318 call. The stock has to move $8 for you to break even on the trade, because you got to not just have the stock go up, but you have to pay back the $817 or $8.17 a share. So you got to gain $8 before you get profitable. What happens if you're right, but it goes sideways and it makes its next move higher in 90 days and goes to 400? Well, you've already lost your call. It expired, probably worthless. That's one of the bad things about trading options, is there's no expiration when you own the stock. There is an expiration date when you own the option. So that's one of the things that's tough. And I'll show you one of the others in a little bit of why I don't disagree with the Options Industry Council of why options are considered risky. All right. So we looked, what about selling a put? I hate that trade. Okay. And I'll show you why. I'm buying gold because I think gold has just broken out of a nice big move and a big base, and it's going to go much higher. Well, if I sell you a put and I'm collecting $7 per contract, or $700 for 100 shares of control, I could lose $7 in the stock price. The opposite of buying a call, I can lose $7 before I start losing money on the trade. But it's a short position. I've got that all the way down to zero potential risk. So I could still lose $3,100 just like buying the stock. No one's going to hold it to zero, of course. What I don't like about selling the put is I've got unlimited risk and I'm capturing a small amount of money. Now, why would anybody in their world in their right mind sell puts? Well, if you're a zillionaire like Warren Buffett and you like gold at $318, wouldn't you like it even more at $310? So I would be collecting premium, and if I have to buy it for 318 minus the 317, whatever, 318 minus the $7, if I had to buy it for 311, I'm buying it at a discount. So a lot of people will sell premium, sell puts, have no problem if they end up getting the stock at the agreed on price because they're collecting premium, which will reduce some of their risk. But I don't love the trade because it caps my upside. So let's take that one away. All right. What about a spread? All right. This is not, it's not an expensive option, but let's think, say I only think the stock's going to go up 10 bucks. So I could buy a bull call spread. And in this case, I am buying an at the money call and I'm paying 8 bucks. But I don't think this is going to move 3% in a month and a half. So I'll sell you a 328 call. What's the difference between 328 and 318? 10 bucks. So for every 100 shares, I can make 1,000. But oh, wait a second, I got to pay you back. I got minus the $386. So the most I can make on this trade is $615. My cost to entry, where on the plain call it was 800 and some dollars, it's only 386. I've capped my loss at that 386 because I'm buying long positions. There's no short position. So the most I can lose is the money I paid to get the position, which is 385. The most I can get paid out is 10 bucks, but then I got to subtract the 385. So again, not my favorite trade if I'm positional. Why? Because, oh, hold on one second. I've just got B4. Hold on. Doing video now. Sorry about this. I just wanted to get a message to Praveen. I've been waiting for him to return my call. It's this holiday weekend. I'm not going to assume he can talk to me. All right, I'm back. So the benefits of this trade: low money in, low loss potential. Downside is you're limiting your upside, even though you're buying this because you think it's that you're buying gold because you think it's going higher. Bull put spread, it's kind of like selling a put. The good news is you collect premium, so you get paid $4.04 to take the trade. That goes right in your pocket. Multiply that by 100 shares, it's 400. Multiply it by 1,000, it's 4,000. So you put that money in the bank, but you're risking the difference between the two strike prices, which is 10 bucks. So you only have to move. Let's see. Actually, you don't have to move at all because you can lose up to 4 bucks, which is the credit you got before you go negative. Your maximum gain, though, is minus 10 or versus, well, the maximum gain here is the 10 bucks plus you get to keep the $404, but this is it right here because it's a put spread. So the maximum gain is that $404 you get paid. Remember, it's got to move against you $4 before you're negative, and your maximum loss is this $10 minus the four you got paid, or about $6. So again, if I'm directional, I think something's going higher. If I'm buying a biotech because I think the news is coming out, if I think something's going to be bullish on earnings, if something's broken out and I think it's going much higher, I don't want to take a trade where I'm only keeping the premium, and I want to be careful with anything that caps my gain. So that's out. All right, so that's a bull call and a bull put. We've talked about long call, long stock. We talked about a short put. So now we're getting to the good ones. Um, what about doing a cover call? Not my cup of tea, okay? Because just like selling a put, I'm collecting I get a credit, okay, because I sold you a call. The most that I can make on this is the difference between the current price and what the strike price is of the call. So this is selling a call at the money. So I'm going to get paid $8. You are going to have the right, but not the obligation, to take my call away, to take the stock away from me at $318. So if the stock goes to 380 and you're on the other side of the trade, you're going to get for $8, you have the right to buy the stock for $318. You sell it the same day for 380, and you made 62 bucks on that trade. So the beauty of this is the guy that's, I think, is is selling me the call. Why do people do a covered call? Because they'll look at it differently than I just described. What they're going to say is, I'm going to put out $318 and I am going to make $8 in the next 6 weeks. 8% on 300 is probably about 2.5%, 2.6%. And I'm making it in 1/8 of a year, 1/7 of a year, say. So if I'm making, say, 2% 7 times in the year, that's a 14 or 15% return, probably a little higher. So I would be buying the stock, collecting the premium, and recognizing if it gets a big gain, all I get to do is keep that premium. But let's say I'm a little bit nervous about the market right now. I could sell calls maybe above the current price on stocks that I own today because I think the market might go back a little bit. And so I get to put that premium in my pocket. And in fact, that premium of $8.18 that I got with a covered call gives me $8 protection on my purchase. So the market would have to drop almost 3% before I lose money. So the good part about this trade is if it doesn't move much to the upside, I win. I get to keep the credit, and I make money because you're not, you will not sell. I will not sell the stock for the 318 plus the $8 if it goes sideways. You might still take it away from me, but I could buy it right back. I get protection to the downside, at least as much as the credit I kept. But again, I still have big downside because I could be holding the stock and they could miss their earnings and drop 40%. Well, if the stock dropped 40%, which would be $120, having the $8 cushion is not going to be that happy, make me that happy. So um, again, this trade works for some people, and I think what it works for is somebody that wants to make 2, 3, 4, 5% every month, every 2 months, all the time, and they're creating income. Same as the person selling the puts. All right. This looks a lot like selling the put, except you got to buy the stock too. Selling the put, you're keeping the premium, but you have a lot of loss potential. It's very much like a covered call. The difference is selling the put, I get the credit in my pocket, I get the same cushion, but I have negative cash exposure, which means I need a lot of margin. All right, so I'm not going to like the covered call. So let's just go in here. Let's clean up our list. Let's take off the short put, take off the covered call, and let's talk about what's left. A butterfly. So here's how you construct a butterfly. You buy a call, and this one you're buying it in the money. Let's change this. Let's move that up to 315. Let's sell two, 10 bucks away, which would be 325. And let's buy a protective one at 335. And I'm going to hit OK, and it's going to look the same. Okay. So stock's at 318. I am buying a call at 315 that's in the money. It's an expensive call. It's $9.70. I am selling two calls for 325 at 530 a piece. That generates $10.60, which covers the cost of my long call. That's great, except what if the stock goes to infinity? I'm sitting there short a call. So I'm going to buy a call at 335 to protect myself. So you're buying one near the money, selling two at $10 away, and then buying one at $10 beyond that. It's cheap. It's $1.78. I am controlling 100 shares for $1.78. The most I can lose on this trade is $1.78 per share, not the $8 of buying the call. Now, this is a horrible trade. I'd rather be selling the spread and risking, I could lose $10, and get paid $1.78. I just don't like that math. But buying this trade is like jumping out of an airplane with a parachute that you can't steer and landing on a 4-foot bullseye at 20,000 feet. It's going to take a very skilled person because you had to max gain. The price has to finish at 325, which is the price of the two short calls. And then you would make the delta of $10 between the 315 and the 325 minus $1.78. So the most you could make on that call, that option's $8.22. But if it goes up to 335, you made $10 on the long call spread. You lost $10 on the short call spread. And so now you're just losing. If you're beyond these 2 points, you are losing the cost, which was $1.78 per share or 178 per contract. What's the advantage of buying this trade? I couldn't tell you one. I don't take this trade. You've got to be skillful and really be good at predicting where the price is going to go. It's not a bad thing to sell, okay, because you're putting money in the pocket on something that's very difficult for it to work correctly. But why do I even have a butterfly here? It's a neutral strategy, and I'm going to show you why. Because that's not the trade I take. I would actually come in here, and I think gold's going to go to 335. So I'm going to increase the ones that I'm selling to 335, and I'm going to make that one 340. Watch what happens. I went from $1.78. It now costs me $6.11. What did the call cost me? About $8.10. So it's less than the call. So the most I could lose is the payment. So I'm buying something that's cheaper than buying the call, which means it only has to move $6.11 to be in the money. Boy, this is an hour. I apologize for that. But I will control, and I don't have to be good. I can go right through my peak and I fix at a profit here. So I like this trade because I'm 20 minus 5. So I make $15. I'm paying $6 essentially. That's 2.5 return. And as long as this thing goes up, I make money. Got to go up to $6. This is called a broken wing butterfly, and it's how you construct it determines how much money you make or you don't make. I like broken wing butterflies. They're lower cost to get in than a call. They are easy to manage. If I mean, you can trade out the short arms if the stock price goes up too fast. Um, Nice fat green area to make money and a cap. All right. Let me show you a couple other trades I like, and I got to pick it up. Let's look at a call ratio back spread. In this trade, I am buying two 328 calls, which means it's got to move $10 in my favor to get there. And those two calls are going to cost me $8.66. And I'm going to sell a call at the money for $8.18. So I am going to own two calls. I'm going to be short one call, and I'm not paying a penny. So the cost to entry is zilch. Why is that good? Here's the price today. If the stock drops $5, $10, $20, all I can lose is $47 on 100 shares. Ain't too bad. Here's the challenge. I'm short a call spread of 318 to 28, and then I have a free call that's mine for the rest of perpetuity on the dating. So I've got to move from here to here. So I've got to move about $20. And at $20, I lost $10 on the short call. I made on the short call spread. I made $10 on the long call spread. And so those wipe each other out. And then I'm sitting here with a call above 328 where every penny is profit. So the bad news is I have to move a lot to get there. But if the stock doesn't change price, if the stock drops, I'm only out the 47 cents, not the $810 to control 100 on a call. It's an interesting trade. It's got to be something that moves. And if I was taking this trade, I probably wouldn't take it in September. I'd want to, this is a trade when I'm very bullish about a move, but I like it. A lot of target area, not a lot of risk. My maximum loss is if I run up to that 328 amount and the remaining call's worthless, but I lost $10 on the spread. Not a bad trade. A little bit harder, I think, to understand and construct, but that's a trade that I take, and I'll take it fairly often because I really like the fact that I don't have downward protection, but if it drops a lot, it goes into I only lost the skinny premium. Different ways of constructing. So now I'm going to leave you with a couple. A married put. This one's kind of cool. Imagine you've had a bad year. Been a good year for most of us. Imagine you've had a bad year and you want confidence builders. One way to do that is to buy a married put. You buy the stock for $318. You buy a put for $7 at the strike price. The maximum that you can lose here is the $7 of that put. Now, just like buying the call, And you notice it looks just like the call. You have to move $700 to turn profitable. That's worth the eight versus the $800 if you bought the call. Just like buying the call, you have unlimited upside, and your downside is just the stop loss. So you know exactly where you are. And when I sit down and I look at charts and I look at risking up to 8%, for 6 weeks of upside opportunity, I'm risking less than 3% on this stock. It's a beautiful position, and it has the exact same thing as a call for less money. The difference is you got to have the capital to be buying the underlying stock. This is a confidence builder because the one time you actually buy a put to protect your downside is when the stock goes to the moon and you go, damn, I could have saved that $7. Sorry for my bad language. And now I'm going to leave you with the trade that I took on gold. This trade would have been fine. I just didn't want to put that much of my margin at risk, especially when I think the market's overall going to tank. And I want to have a lot of powder for when that happens. Remember what the long looked like. And to control 100 shares, it was $31,807. What does that look like? Just like the long stock, but it's only costing you $115. It has the exact same P&L as owning the stock. Instead of putting out $31,000, you're putting out whatever you're buying a call at the money, you're selling a put at the money, you're spending $1.15, and you have essentially the exact same P&L of buying the stock. It's a beautiful trade. I had a big Amazon trade that went my way that as I've gotten older in life and see my working years getting less and less, there's no way in hell I would take that trade again. Imagine if you were 10,000 shares short. All right, so 10 is 1,000. You did 100 contracts of this. That's 10,000 shares worth. 10,000 shares of a $318 stock. I think that would be, is that like, let me do the math because my head is fried. I've obviously been talking a long time, but historically, people like when I go through my thought processes. 318 times 10,000 shares. One, two, three. I think it's $3.2 million. $3.2 million. Do you want to put $3.2 million of risk on a trade? No. You might, but most people don't. If you were to take this trade, it's perfectly fine. But don't take more of this trade than you would buy shares. If you were going to buy 500 shares of this stock at $300, okay, so 318 times 500 is 160,000. Great. Then take 500 shares here, which is 5 contracts, and pay $750 to get the same control as spending 159, and then put a stop loss and don't let it go to zero. All right. That is a perfectly wonderful trade. I can make this trade safer. And the trade I took on the gold was I basically took this trade and I added an option. I'm going to add an option leg. I'm going to add a put. I'm going to buy a put, and I'm going to buy a put that's say 300 and can't remember what I bought. Let's say $310. Nah, yeah, 310. That's fine. I'm going to hit OK. I just capped my loss. It's $470 to do this, to control 100 shares. Now I only have to move $4.70 to be profitable. I don't have to worry about a black swan event and wiping out generational wealth in my family. I can control 100 shares for 470 instead of $38,000. I love this trade. And this is the trade I took on gold. It has to move in my favor for me to make money. But I have unlimited upside and I've capped my downside. And oh, by the way, you don't have to hold this to expiration. And that you could move $3 or $4 in your favor and you could sell it and put some money in the bank. But that's the trade I took. And so I went through what I consider my favorite bullish option trades. I apologize for the hour and 10 length of time. Um, this is how I teach. Um, I think my style works. May not work for you, but it worked in medicine, seems to work okay at my live meetings. So what do I want? Infinite gain. I want to have a low cost of entry, and I want to have unlimited upside, and I want a fixed risk. So that's how I played gold. Hope you have a great week. Join me tomorrow. I'll put the link in for another teaching event live. You can ask me anything and have a great night. Thanks, everybody.